If you look at the stock chart of Marqeta, it looks like a disaster. The stock is down over 80% from its highs. But if you look at the actual business, something does not add up. The gross profit is up 27% year over year in Q3 2025. In December 2025, they announced $100 million in stock buyback, which brings the total for the year to $400 million. Think about that for a moment. The company is worth about $2 billion. The authorized buybacks equivalent to nearly 20% of the company. The market hates this stock because they see Block, a business that is slowing down. But I like this stock because I see ramp, credit, and AI, a business that is just getting started. In this video, I'm going to tell you about a company you use every day, but probably know very little about. First, let's look at the numbers. It seems like the company is actually generating less revenue than they did in 2023. But what is happening here is an accounting change. In 2023, they changed how they report revenue for their biggest client, Block. They used to count the entire transaction size. However, now they only count the net fee that they keep. The result? Headline revenue looks flat, but gross profit is climbing steadily. In Q3 2025, gross profit hit $115 million, up 27% year over year. To understand this business, you need to know two terms, GMV and take rate. GMV is the total amount of money swiped on Marqeta cards. In Q3 2025, that number was $98 billion, up 33% from last year. You can see the drop here. The take rate fell slightly. Basically, for every $100 you spend on a Cash App card, Marqeta now keeps about 16.6 cents instead of 17.3 cents. The decrease in take rate likely reflects Marqeta's strategy to prioritize volume and client scale over marginal percentage points. But the real story here is financial discipline. While most tech companies are getting bloated, Marqeta is getting leaner. Selling and admin expense dropped 14% even though revenue grew 33%. They have flipped the switch from cash burn to cash machine. In the first 9 months of this year alone, they generated over $100 million in free cash flow. Based on the estimated $314 million free cash flow in 2026, the worst-case scenario, assuming zero growth, the stock trades at an enterprise value to free cash flow ratio of just 4.28. This implies the company could generate its entire enterprise value in cash in just 4.5 years. The stock trades at an EV to gross profit ratio of 3.23. For a company growing at 27%, this is priced as if it has zero growth potential. The company is operating with almost no debt and a massive war chest of $750 million in cash. Even under a scenario where Block revenue declines significantly, projections indicate the company could remain free cash flow positive starting in 2026. 11 analysts are currently covering the stock and their median upside projection of 23%. The stock is currently trading 45% below its 52-week high and 28% above its 52-week low, suggesting the bottom is in, but there is significant runway for growth. It would need to increase 7-fold to reclaim its all-time high. The stock is consolidating and trading very close to both its 50-day and 200-day moving averages, often a precursor to a breakout. Meanwhile, short interest is in a decreasing trend, sitting at only 4.38%, indicating bears are leaving the trade. The ownership structure is highly concentrated, with institutions holding 85% and insiders holding over 6%, leaving a very small float for retail, which can lead to rapid price appreciation on good news. Now, let's talk about what Marqeta actually does. To understand the value, you have to understand the tech. Marqeta isn't just a card issuer. They invented something called just-in-time funding. Let me explain this simply using Instacart as an example. When you order $100 worth of groceries, the delivery driver walks into the store with a card in their pocket which actually has $0 on it. If they try to buy a candy bar for themselves, the card would decline. But the moment they swipe the card at the register for your specific order, a magic trick happens. Marqeta intercepts the transaction in milliseconds. It asks questions to Instacart's server like, hey, is this driver number 5? Is he at the Whole Foods on Main Street? And is the total roughly $100? If Instacart's server says yes, Marqeta instantly injects exactly $100 into the card and approves the transaction. Legacy banks cannot do this. They just check a balance and say yes or no. They can't check context. This technology is critical to gig economy. And this technology has evolved through 3 distinct phases. Phase 1 was the gig economy. In 2013, DoorDash became their first major win. They needed just-in-time funding to stop fraud. In 2015, Instacart came around with the need to load exact amounts on shopper carts. Later in 2016, Block launched the Cash App card on Marqeta's rails. Phase 2 was the global titans. Uber dropped their old provider to switch to Marqeta for global driver payouts. And JP Morgan, the biggest bank in America, started using Marqeta for commercial virtual cards. This all happened in 2020. Phase 3 is the B2B era, where they signed customers like Ramp and Bill.com, who are the biggest names in business payments. They also signed other giants like Walmart, Google Play, Klarna, and Affirm as their customers. The beauty of this model is embedded growth. Marqeta grows if their clients grow. They don't need to go out and find 100 new customers every year. They just need their customers to get bigger. As those companies process more volume, Marqeta gets a raise automatically. It is the ultimate land and expand business. Now let's take a look at some of Marqeta's major customers and how they are growing. In their most recent quarter, Affirm's gross merchandise volume grew 42% year over year. The US market is on fire for Klarna. In Q3 2025, their global GMV grew 23% year over year, but specifically their fair financing product, which relies heavily on virtual card infrastructure, grew a massive 244% year over year in the US. Ramp is the fastest growing spend management platform in history. As of November 2025, Ramp surpassed $100 billion in annualized purchase volume, with revenue growing 54% year over year. Similarly, Bill.com's card usage is surging. In last quarter, their specific spend and expense card payment volume grew 21% year over year. Then comes DoorDash. Their gross order value surged 25% year over year in Q3 2025. Instacart continues to steadily expand, with gross transaction value growing 10% year over year. The calculation I showed earlier was based on no growth at all, but Marqeta is going to grow immensely in the next years as services like BNPL and B2B spend management takes off. Now let's talk about growth engines. They have started providing full-fledged credit card services. Think of Delta Airlines partnering with Amex for their credit cards. The problem is that Amex will own all the customer data and Delta will just get a check. The new way is embedded credit. Imagine an Uber card that lives inside the Uber app. You pay your bill inside the Uber app. Uber sees exactly what you bought and gives you a coupon for a ride home. Instead of splitting profit 50-50 with a bank, the brand keeps 80% of the profit, paying Marqeta a small management fee. Another use case is neobanks like Dave and Chime already have your checking account. Now they want to lend you money to make real profit. Building a credit engine is difficult and takes years, but with Marqeta, they can launch a credit builder card in 3 months. US credit card volume is 5.6 trillion compared to debit at 4.9, but the profit pie is the real story. Debit fees are capped and low margin, whereas credit fees are uncapped plus interest income. The total revenue pool for credit is more than 5 times larger than debit. Marqeta is moving from a small pond to an ocean. For years, Marqeta was just a Visa MasterCard shop, but the integration with Amex is nearly complete. This is massive because Amex dominates the corporate travel market, which is high spend, high fees. Marqeta is becoming the universal adapter for money. It does not matter if a business wants to issue Visa, MasterCard, or Amex. Marqeta is the single API for all of them. In November 2025, Klarna moved millions of cards in 15 European markets to Marqeta. Why? Because of a new tech called Visa Flexible Credential. This card is magic. You swipe it at a coffee shop, it's debit. And you swipe it at an Apple store, it automatically switches to credit. Only Marqeta can handle that logic instantly. I estimate this Klarna deal alone to be worth over 25 million. This European win with Klarna wasn't an accident. It happened because of a specific acquisition, TransactPay. In Q3, Marqeta bought TransactPay for a very specific reason, the license. Previously, to operate in Europe, Marqeta had to rent a license from a partner bank. That partner took a cut of the profit. TransactPay has an e-money institution license, and by buying them, Marqeta became the bank in Europe. Now, let's forget about the past for a second and talk about the future. The next war in fintech isn't about humans swiping cards. It's about AI agents spending money. Here's the problem. You can ask ChatGPT to plan your vacation, but you definitely cannot ask it to book the flights. Why? Because you are terrified to give an AI your credit card number. What if it hallucinates and buys a 50 grand first class ticket? This is where Marqeta just dropped something called the MCP server. They released a tool that lets AI agents like Claude or ChatGPT to talk directly to Marqeta's bank. Now, if you're wondering how it works, let me break it down for you. You tell your AI, book me a flight to London, max $800. The AI talks to Marqeta's MCP server. Marqeta then instantly spins up a virtual Visa card with a hard limit of exactly $800 that expires in an hour. This can only be used to buy tickets in your name. The AI uses that card to book the flight. But if the AI tries to spend $801 in someone else's name for another location, declined. This solves the trust problem instantly. This does not mean AI is taking over payments tomorrow. It means Marqeta has built the layer that makes AI payments possible. Now let's talk about who Marqeta is competing with in the market. Marqeta is the best in the business in what it does, but the landscape is highly competitive, with the biggest one being Stripe. If you're a small fintech or a YC startup, you probably go to Stripe because it's fast, easy, and developer friendly. Stripe can handle most standard card issuing, but when the rules get really complex, like only works on Tuesdays for gas, under $500, or synced instantly to your accounting system, that's where Marqeta shines. Galileo, which is owned by Sophie, powers Chime, Robinhood, and other consumer fintech apps. They're strong in B2C, but if you're building a complex B2B card program with dynamic spending rules like Ramp, Marqeta is still the better fit. Adyen, on the other hand, has its own license in Europe and handles both payments and issuing. Big global brands love them because they want one provider for the US, UK, and Europe. That's exactly why Marqeta bought TransactPay, to get a European EMI license so they can offer a one-stop shop solution and compete head-to-head with Adyen. Now let's talk about potential risks. Last year, Varo, a bank, signed a 5-year deal with Marqeta, but it was terminated after about a year. The takeaway? Marqeta is just too expensive, and integration is not easy for banks that only want simple, low-margin processing. This confirms that the commodity debit market isn't Marqeta's sweet spot. Marqeta relies on partners like Sutton Bank for US banking licenses. Sutton powers Cash App cards, which is almost half of Marqeta's revenue. There have been reports of regulatory scrutiny on Sutton regarding AML compliance. If regulatory intervene, moving millions of Cash App cards would be messy. This is a real risk, but it's not a confirmed shutdown. Marqeta has been trying to diversify their risk and has added a couple of banking partners. The biggest risk of all is management confirmed that some of the new Cash App card issuance will shift to another vending starting in 2026, creating about a 2% drag on total revenue. The bigger fear is, what if Block eventually moves everything? That's nearly half of Marqeta's current revenue. While that is almost impossible, as 24 million Marqeta-issued Cash App cards are stored in Apple Pay and Google Wallet. If Block switches providers, users would need to re-enter their cards, and Block does not want that. So, at the worst, it's a likely gradual revenue bleed, not an instant cliff. The contract with Block lasts till June 2028 and will most likely be renewed, but Marqeta will most definitely take a huge hit, as more and more renewals and new card issuance will be shifted to a new vendor. Another unstable area is leadership. Marqeta has had 3 CEOs in 3 years, which signals instability, with a lot of employees saying the company constantly reprioritizes tasks and has lack of direction. In February 2025, CFO Mike Milotich became interim CEO. After his takeover, the strategy has shifted to profitability and efficiency. Milotich, who previously worked at Visa, has done a great job cutting stock-based compensation and other costs and focusing on both the top line and bottom line growth. Now let's talk about the valuation. What is the company actually worth, and should you buy it? Let's start with the most aggressive signal in the market, the buybacks. In 2025 alone, Marqeta reduced its total share count by 13%. After their IPO, they had around 540 million shares outstanding, and as of Q3 2025, the number had decreased to around 450 million, and they still have 750 million cash. I expect them to generate at least $1 billion in free cash flow by the time their Block contract is up for renewal, which would enable them to buy back the entire company at current price. There are some warrants which could dilute the investors, but it's very minimal. Marqeta has issued commercial warrants to partners like Uber and Block. But Uber only gets those shares if they hit massive volume targets. I want Uber to have these warrants. It creates golden handcuffs. It incentivizes them to route 100% of their volume through Marqeta so they can earn the stock. It simply locks them in. Now look at the multiple. Marqeta trades at roughly 3.2 times its gross profit, whereas competitors like Adyen trade at 8 and Visa trades at 15. For a fintech growing 30%, a 3 times multiple is dirt cheap. The market is pricing Marqeta as if it is going out of business because of the Block noise. Current free cash flow is at 133 million annualized, whereas cash on hand is at 830 million. The bear case is we assume Block leaves in 2027. We take the 202 million in gross profit they generate and wipe it out. We also subtract the entire amount from our cash flow. We add 30 million for the new Klarna deal and assume the rest of the business grows at a slow 10%. Even after this disaster, the company is still generating 158 million in free cash flow. Put a dying business multiple of 10 times on that. Even legacy processors really trade below 12 to 13 times free cash flow unless revenues are collapsing. Add the cash and you get a share price of $5.50. The stock is trading at $4.90 right now. The cash alone is nearly $2 per share. That means the market is currently pricing in a scenario worse than Block leaving entirely. Now, the base case. Let's assume Block stays but slowly fades. 5% a year, accelerating to 20% each year until it is zero after 2027. The B2B business like Ramp and Bill.com grows at 15%. The growth from the new business, 250 million plus base growing at 15%, easily overpowers the decline from the old business. Free cash flow grows steadily to 400 million over the next few years. At a standard 15 times multiple, the fair value is $15.50. This is a 3 times return from today's price. The bull case is Block stabilizes, shrinking only 2% a year, and Marqeta loses 50% of Block's business slowly after 2027. The new B2B and credit segments explode, growing at 25%, lower than Affirm or Ram's actual growth rates. The company becomes a cash flow monster, generating nearly $500 million in a free cash flow by 2028. Give it a growth multiple of 20 times. The fair value is now $22. This is a 4 to 5 bagger. None of these scenarios assume contribution from Marqeta's emerging credit infrastructure or agentic payment workflows. Any success there represents massive upside. At today's price, investors are getting Marqeta's next product cycle for free. Here's the final verdict. For me, Marqeta is a strong buy. The risk-reward is asymmetric. You risk $1 to make 5. The market hates it because of the block noise. But you are effectively buying all the new business for free. You are buying a company with 30% of its market cap in cash, growing gross profit at 27% and buying back 13% of its float in a single year. That said, I would not go all in with the stock or buy options at this point. It might be a while before the market realizes this gem. If Block stays, B2B and the credit infrastructure works, it could be a potential 10 bagger.